Today we're talking about something cool. It's called diversification. Imagine it like you're at a party and each guest is an investment. Now, you wouldn't want to hang out with just one person the whole night, right? That's where diversification comes in. It's like being the life of the party, mingling with a variety of guests. In the investment world, this means having a mix of different investments in your portfolio. It's like having your own personal party mix of stocks, bonds, real estate, or even cryptocurrency. This way, if one investment starts to bore you, or in other words, doesn't perform well, you've got plenty of other interesting guests to interact with. But before we continue, do me a quick favor. Hit that subscribe button, like this video, and show your support for free educational content like this. So the question now is, how do you create this perfect party mix? Studies suggest that having 15 to 20 stocks in your portfolio is like having just the right number of guests at your party. Too few, and the party is a dud. Too many, and it's overwhelming. The goal is to have a well-balanced guest list that can keep the party going, even if a few guests decide to leave early. But let's talk about the strategy behind diversification. You wouldn't invite the same type of people to your party, would you? Similarly, diversification is about investing in different types of assets. You could have a mix of extroverts, stocks, introverts, bonds, the life of the party, real estate, or even the mysterious ones, cryptocurrency. The key is to have a variety of guests who react differently to the party vibes, just like how different assets respond to market changes. So, in short, diversification is all about throwing the perfect investment party. Remember, the goal is to get together with a variety of guests and keep the party interesting. Diversification isn't just about having a variety of guests at your party. It's also about how these guests interact with each other. This is known as correlation. If all your guests are dancing to the same beat, your party isn't truly diversified. Similarly, if all your investments trend up or down together, your portfolio isn't appropriately diversified. For instance, high-yield bonds often have a positive correlation with stocks. Therefore, a portfolio made up entirely of high-yield bonds and stocks is not well diversified. Asset classes are like the different types of partygoers. You've got your equities, stocks, fixed income investments, bonds, cash and cash equivalents, real assets including property and commodities, and exchange-traded funds. ETFs. ETFs are a type of investment fund traded on stock exchanges, like individual stocks. They can contain a variety of investments, including stocks, commodities, or bonds, and they often aim to track a specific index. Each of these asset classes has varying levels of risk and returns, so including investments across asset classes will help you create a diversified portfolio. Diversified investment portfolios generally contain at least two asset classes. For example, stocks and crypto, or stocks and foreign exchange currencies, Forex, or even ETFs and commodities. So what does it mean, diversification within an asset class? Diversification within an asset class is like having a mix of guests from different industries at your party. If you invest in energy stocks, for instance, consider adding technology, biotech, utility, retail, and other sectors to your portfolio. This way, if one industry faces a downturn, your portfolio won't be overly affected. Also, don't forget to invite guests from around the world. Diversifying by location is a good idea to consider for global exposure. This way, your portfolio won't be overly dependent on the performance of a single country's economy. For example, buying U.S. stocks and Chinese stocks in combination with Euro-USD and Pound-Yen currency pairs. In the world of investing, there are growth stocks and value stocks. Growth stocks are shares in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks often trade at a high price-to-earnings ratio, PE ratio, but can be risky if the company does not meet expectations. PE ratio plays a key role to my trading strategy, but because it's a video on its own, we are going to talk about it more in other videos. On the other hand, value stocks are securities trading at a lower price than their fundamentals, such as dividends, earnings, or sales. Investors can find value stocks using various investing strategies or by analyzing the price-to-earnings ratio, price-to-book ratio, and dividend yield. Now, let's talk about the market capitalization mix diversification. Market capitalization, or market cap, refers to the total market value of a company's outstanding shares of stock. It is calculated by multiplying the company's share price by the number of its outstanding shares. For example, a company with 30 million shares selling at $100 a share would have a market cap of $3 billion. On the other hand, a second company with a share price of $1,000 but only 5,000 shares outstanding would only have a market cap of $5 million. Large cap stocks are shares of companies with market caps of $10 billion or more. They are generally safer investments than their mid and small cap counterparts because the companies are more established. Small cap stocks, on the other hand, are stocks of companies with market caps of $300 million to $2 billion. Small cap companies have the potential for high rates of growth, making them appealing investments, though their stocks may experience more volatility and pose higher risks to investors. It's wise to own both large-cap stocks and small or mid-cap stocks in a well-diversified portfolio as it lowers the risks. Diversification isn't just about spreading your investments across different asset classes, industries, and geographic regions. It's also about diversifying across different platforms. This could mean spreading your investments across different brokerage accounts, or it could mean diversifying your brand or business across different social media platforms. Choosing the right brokerage account is one of the most important parts of your trading journey, and there are a few things to take into consideration before you sign up for a specific brokerage account. First, you must ensure your funds are secure on the specific broker. Second, to be able to have access to a diverse array of instruments, stocks, crypto, and more. Third, regulatory compliance, a broker that is regulated by financial authorities. Fourth, low fees and transparent pricing. Fifth, user-friendly interface. And lastly, educational resources along with customer support. Now, let's talk about the platforms that I personally use and recommend. For stocks, ETFs, and basic crypto, I turn to eToro. When it comes to a wide range of cryptos, Binance is my go-to platform, and for analyzing the charts, I rely on TradingView. So, reasons I personally use eToro: securely held funds in a regulated UK or EU bank, two-factor authentication, and biometric verification prioritize safety. Diverse trading options including stocks, crypto, commodities, and more. The platform also has low fees and transparent pricing. Another very exciting feature eToro offers is the copy trading option. With a few clicks, you can copy someone's full portfolio and let it run to autopilot. I will create a video talking about that in the upcoming days. Another platform I use for my crypto investments is Binance. Here's why Binance deserves a prime spot in your investment party. Binance employs cutting-edge security features to safeguard your digital assets. With industry-leading practices, your crypto investments are in safe hands. Binance has an extensive list of tradable assets. From popular tokens to emerging altcoins, Binance offers a diverse range of investment opportunities. And last, for my technical analysis, I use TradingView. Your go-to analysis platform in the finance world is a must-have guest for your trading journey. And here's why. Extensive array of advanced tools and charting options for stocks, crypto, forex, and more. TradingView provides a dynamic environment to enhance your trading strategies. Enjoy a user-friendly interface that caters to both beginners and seasoned traders. If you want to register or check them out, the links are in the description below. Now, to conclude this video, there's a question to be answered. Why diversify? The answer is simple: to manage risk and potentially increase returns. By spreading your investments across different asset classes, industries, geographic regions, and platforms, you can help ensure that no single investment has an outsized impact on your portfolio, leading to a more consistent overall return and helping you reach your long-range financial goals. The benefits of diversification are numerous. It can potentially offset poor performance with better performing investments, open doors to better opportunities, provide enjoyment in researching new assets, and contribute to higher risk-adjusted returns. And that's the magic of diversification. It's your key to a balanced and resilient portfolio. But remember, it's not just about variety, it's about dodging the downsides too. And of course, if you haven't checked the first video about the Guide of Investing for Beginners already, go check it out. I'll leave a link in the description below. Now, if you enjoyed the content, smash that subscribe button and like the video. Your subscription keeps you updated and shows the video to more people, helping me provide more free content like this. Join us in growing this community of free education. See you later.